We're here to talk about regulation and how that can help develop and enhance green finance. I'm Chris O'Donovan, so I work in the Treasury within the Financial Services Directorate, and I've recently been working quite closely with Bays and other colleagues across Whitehall and with the finance institutions we have here to work on the publication of the government's green finance strategy. And I think for a conversation on regulation and green finance, I think we've got the perfect panel lined up ahead of us. So we've got Sarah from the Bank of England, we've got Clare from the FCA, Phil from the FRC, and Fiona from the Pensions Regulator. Now, all institutions represented here today have participated in the joint statement that was published alongside the Green Finance Strategy on the 2nd of July to clarify a joint understanding on the concept of climate change risk, making sure that we're all working together on this agenda. On format for the panel, I think it would be, we're going to keep things relatively simple, so we'll run through the panel with brief introductions and an overview of what each institution is doing. I'll probably end things with a brief discussion on the EU Sustainable Finance Action Plan as well, before handing it over to you for questions. And on that note, I'd like to hand it over to our first panelist, Sarah.
Hi there. I'm afraid that today it was billed for as Chris Faint on the panel representing the Bank of England. Chris heads up the Climate Hub within the Bank of England, and I'm afraid he wasn't available this afternoon. So my name's Sarah Kemmitt. I'm here as a banking supervisor. That's my normal day job. At the moment, I'm on a secondment to our Climate Hub. But over the last couple of years, I've been quite involved in working out how we should be supervising climate risks at our regulated firms. And I think one of the key challenges for us as regulators is that climate risks are quite distinct from all the other risks that we have to supervise within firms, and they're quite distinct in three different ways. So firstly, they're extremely far-reaching, so in breadth and magnitude. And if you think of the balance sheets of the firms that we regulate, climate risk probably touches on most of the areas of firms' balance sheets in one way or another. It crosses across sectors, across geographies, and across products. So that's a bit different. The other thing is that they're foreseeable risks, but we actually have no idea how they're going to play out. But what we do know is that it's inevitable that we are going to experience a mix of physical and transition risks for the firms that we regulate. The precise mix of how that happens really just depends on the trajectory of emissions of greenhouse gases that we actually manage to achieve over the coming decades. And it's also challenging because of the really uncertain timeline. So these risks are likely to transpire outside of normal business planning horizons. So when we've surveyed firms, we found that their normal business planning horizon is about 4 years. So this is a challenge because firms aren't sort of used to looking this far ahead. But that's really vital because how the risks actually play out are going to be determined by the actions that we take today. And so that requires a really strategic response. And I think everybody can recognise that really we're not going fast enough in that regard. So I'd just like to mention today 4 initiatives that the Bank of England's been very involved with or initiated. There's an awful lot going on at the Bank of England at the moment. So this is just a handful of initiatives that we're doing. The first is the supervisory statement, which we published back in April. And we've set out in there our expectations of how firms should address climate change risks in respect of governance, risk management, scenario analysis and disclosure. And we've asked firms to write to us at the end of October, setting out and telling us how they're going to meet those expectations. So we're now just starting to get a trickle of those those letters and plans coming in. It's worth noting that our supervisory statement was intentionally very, very high level. So we've really steered away from being prescriptive in this area. And that was purposeful, really, because we don't want to constrain firms' thinking in this area. And, we also really want to avoid this being turned into a compliance exercise. We want firms to be thinking deeply about this and strategically. The second initiative that I'll mention is the Climate Financial Risk Forum, which was convened by the PRA and FCA. So I should imagine my colleague from the FCA will also talk about this. So I won't say too much, but I think the vital thing to note about this is that it is led by industry. So we convened it, but it was very important to us that this was an industry forum, and it comprises banks, insurers and asset managers. We were really, really pleased with the level of interest that we had. Loads of firms wanted to be involved with this work, so it's really encouraging. And the aim of the group really is to build capacity and to develop best practice. And there are 4 working groups there looking at risk management, scenario analysis, disclosure and innovation. And we're looking forward to getting some quite kind of practical manuals coming out of that next year. The third initiative that I'd like to talk about is stress testing. Stress testing the whole financial industry for climate risk. So you probably know that the PRA does stress testing of our largest banks concurrently every year. So we call that our annual concurrent stress test. We also complement that with a biennial exploratory scenario. And later this year, we're going to be publishing a discussion paper to initiate discussion with industry on that about, the best way to approach this. I think everybody is really learning on scenario analysis. And we expect to run this in 2021. So the reason we're putting that out so far in advance is because, we recognise that we've all got a lot of capacity building to do in this area. But what we hope to achieve through that is a micro-prudential lens, so understanding what this means for individual firms, but also a macro lens, looking across the whole economy and viewing it with a financial stability view. And we all know that, assessing strategic resilience is very difficult, and we're very keen to not let the perfect be the enemy of the good. And we feel it's better to be sort of approximately right now rather than wait and try and be perfectly right later, because later will be too late. So lastly, the last initiative I'll mention is the Network for Greening the Financial System. So this is a network of central banks and supervisors. The aim of this group is really to help to strengthen the global response to meet the goals of the Paris Agreement. And it's also all about enhancing the role of the financial system to manage risks and also to mobilise capital for green growth and low carbon investment and environmentally sustainable development. So NGFS started a year ago with 8 founding central banks, one of which was the Bank of England. I think we're now up to 46 members and 9 observers, so it's really, really grown. It now covers countries that emit half of the world's greenhouse gases. And what the group aims to do is to kind of define and promote best practice in 3 main areas. So firstly, the microprudential area. So this is all about how we supervise regulated firms. Then in the macroprudential sense, this is all about how we look across the financial system and how we use scenario analysis. So it's developing reference scenarios, etc. And the third area that they're looking at is all about scaling up green finance. And that's all about looking at central banks' own operations and how we manage our own portfolios, but also things like taxonomies and green bond standards, etc. So those are all the things that I wanted to talk about today. Happy to take questions later, but I'll hand over to Clare.
Thank you. So hello, I'm Clare Bolingford and I'm Head of Cross-Cutting Policy at the Financial Conduct Authority. And my team there is responsible for coordinating the FCA's strategic approach to our climate change related work. I'm absolutely delighted to be here on this panel because it's great timing for us. We issued our feedback statement yesterday on climate change and green finance, which sets out our approach and priorities in this area. And I'd like to talk to you a little bit about that today and outline the 3 priorities we've identified in that statement. But I'm also delighted to be on the panel with my fellow regulators and also with the Treasury because coordination in this area is so important, and the fact that we're all coming together to make sure that we have a joined up approach to this is fundamental, because it means that we have a much better chance of achieving the outcomes that we're looking for in this space. But back to our priorities. The first priority we're focusing on is disclosures as part of our approach, and this is particularly around issuer disclosures. So this is issuers of financial instruments into the marketplace, and it's to ensure that issuers inform the market about ESG factors, environmental, social and governance factors, including the effect of climate change on the company prospects themselves. And so we've set out a programme of work that we intend to complete in this area in order to make sure that the market gets the information that it needs. So to support this, we're looking to consult on new rules to improve climate-related disclosures in particular issuers in early 2020. And in particular, we want to see greater consistency. And that's part of the reason why we want to introduce these rules. We also want to make sure that there's proportionality as well. So that's why we're only beginning our consultation on these rules by capturing certain issuers that we think are important, such as the premium listed issuers. And again, only on a comply and explain basis. We think it's appropriate to take a proportionate approach at this stage because we are breaking new territory here. So we need to test it as we go and make sure that we are taking the right approach before rolling it out more fully. We're also keen to clarify existing obligations in this space. So already issuers should be disclosing climate-related risks where these are financially material to their company. However, we have had feedback that it's not always clear what materially means, so we're going to do some clarification of that. This work also feeds into work that we're doing with the Treasury-led task force looking at disclosure of climate-related risks, in particular how financial services firms as a whole should be looking at this topic. The second priority that we've set out is how financial services firms can integrate climate-related risk into their business decisions. And again, we've set out our proposals in this space and also commented on some of the work we've already done in this area. And I'm delighted to say we've been collaborating with the Financial Reporting Council, which I'm sure Phil will come on to talk about in relation to stewardship, having issued a discussion paper with them earlier in the year, and we are looking to feedback on that very shortly, which I'm sure Phil will talk about. But we also intend to create further rules in relation to individual governance committees for pension providers, so that they should report on how they consider ESG within their portfolios as well. And finally, our final priority is around the information and advice that customers receive. We know that there is a growing demand for green finance products in the UK, and we want to make sure that customers are receiving the right information when they are seeking green products and also get the right advice. And this isn't straightforward at the moment because there isn't a collective view of what a green product is. We are working through the EU Financial Services Action Plan to get some more definition on this. But in the meantime, we will be stepping up our monitoring work around what firms are doing in this space at the moment, and are certainly looking at whether any greenwashing is occurring, and will be taking action if we deem that to be the case. But there is also plenty of other work that we're doing in collaboration with other colleagues at the table. And as I said at the beginning, I think it's just great to be collaborating with everybody here to make sure that we can have a joined-up approach to how we achieve the government's strategy in this area. Thank you.
Thank you. My name's Phil Fitzgerald. I'm Director of the Financial Reporting Lab at the Financial Reporting Council. I'll explain a little bit more about what the lab is a little bit later in this presentation, but I'm really representing the FRC here in the various activities that we're doing in relation to this. I would certainly echo Clare's comments that to make this a success, regulators have to work together, and you'll see from each of our presentations how there's significant overlap in the activities that we're doing. That overlap is planned through the collaboration that we've had, certainly, which has accelerated over the last year or so. So I would absolutely support Clare's comments that it's really important for regulators to work together in this very complex space. I know there's also a number of international delegates in the audience today, and I think it will also be important going forward to work internationally on international standards, particularly when we're looking at reporting standards such as TCFD. You know, that needs to be thought on an international basis and not just a UK or national basis, and that's certainly its intention. Just for those of you who don't really know who the FRC is, I know we're probably the lesser spotted regulator in this group. I'm just going to outline some of our activities that are relevant to this conversation. So the Financial Reporting Council sets the UK Corporate Governance Code, it sets the Stewardship Code, and it monitors the quality of corporate reporting and the quality of the work that's done by the audit firms in relation to that corporate reporting. We also have a financial reporting lab, which is a market-led initiative, which I'm going to come back to later on as I talk through some of the things that the Financial Reporting Council is doing. I'm also going to talk about four areas that we're particularly focusing on at the moment. And I'm going to start off with the UK Corporate Governance Code, because we certainly believe that taking action in this area starts with the boards of companies, the leadership of companies, and how the governance arrangements are structured to consider climate change matters on the company. There's a responsibility in the Companies Act, Section 172 of the Companies Act, which requires directors to promote the success of the company, having had regard for a list of different stakeholders, one of which being the environment in which they operate in. And there's new UK requirements for companies to specifically report against how they've discharged their duty under Section 172, which will come through in the first sets of reports for December year ends this year. That will really focus, I think, boards of companies in thinking about how they are taking into account climate change factors, as well as factors from other stakeholders in the work that they're doing or in the direction that the company is taking. In relation to that, the UK Corporate Governance Code, or in anticipation of that and other matters, the UK Corporate Governance Code was updated in 2018. And the focus of that update was very much on how boards of companies are taking into account long-term sustainability factors in their decision-making. Now, that's not only relating to the environment and climate change, but also other factors such as changing workforce and other areas. But we're very much focused, or trying to focus boards of companies on thinking about long-term sustainability, how they take into account long-term risks, how that will affect their business model going forward, and what kind of discussions need to be happening at the boardroom to address some of those areas. So we think with the revision to the UK Corporate Governance Code and the new requirement this year to report specifically on how directors have discharged their duties against Section 172, that will really set a clear clear expectations for directors and boards in how they operate and take into account sustainability factors, including climate change. The second area I wanted to talk about is it's not just companies who have a role to play here, it's also investors. The FRC sets the stewardship code, which sets expectations for how investors engage with companies, what considerations they need to take into account, and how they report on that engagement. As Clare mentioned, we've been working very closely with the FCA in updating the stewardship code, and that should be published shortly. I wish I could say it was published today and I could talk more freely about it, but it will be published shortly and certainly by the end of the year. One of the core elements of the revisions to the stewardship code will be the requirement for investors to take into account ESG factors in their investment decisions and also report on how they've taken into account those ESG factors in their investment decisions in an activities and outcome report. So we think, as well as company boards taking the leadership on this, we think there's a really important role for investors to play, and the new stewardship code will set a very sort of clear direction on what we expect of investors as well. The third area I wanted to touch on was reporting guidance. So if boards are taking the lead on this and investors are pushing them to do so, the third area is, well, how do companies report in this area? The FRC does set the strategic reporting guidelines, which effectively give guidelines to companies on how they should report in the narrative perspective, so not the financial statements, but the narrative part of their annual report, which includes things like guidance on articulating the company's principal risks, what metrics and KPIs it uses, and those metrics and KPIs should extend beyond financial measures to non-financial measures as well, including how the company impacts climate. So those guidelines are there as well. One of the things that I was hearing from this morning's debate was a real need for consistency of reporting in this area. And you know, we have suffered from a large amount of different initiatives, voluntary initiatives going forward, which have all been very well supported and are very commendable. But in terms of getting consistent, comparable data, we need to find a way of getting to a consistent framework. One of the things that the Financial Reporting Lab does, which is where I sit, it's not a regulatory part of the FRC. What it seeks to do is to speak to investors and speak to companies and identify best practice ways of reporting. And we started a project last year on climate change reporting, not with a view of coming up with a new framework and not with a view of supporting a particular framework, but identifying from investors what they're looking for in reporting. As we started the project, it quickly became apparent that there was overwhelming support for the TCFD framework. And in fact, the report that we're about to publish, and I'm sorry, it's another one where I'm saying we're about to publish the report, will set out that investors expect companies to report under the TCFD framework and that companies are working towards that framework. The report will be non-mandatory, but it will provide examples and guidance to companies as to how to achieve the TCFD objectives. And certainly as we move towards the green finance goal of green finance strategy goal of achieving TCFD reporting by 2022, we think that will play a big part in giving companies the confidence and guidance to be able to apply some of those principles. And then finally, the fourth area that the FRC is focusing on is, as well as producing guidance, we also monitor compliance with the statutory requirements to report. So there are statutory requirements to report on how companies are affecting the environment, including climate change. And we will be certainly as laid out in our statement that we produced in July, we will be continuing to monitor whether companies are complying with their statutory reporting requirements. And linked to that, we'll be looking at the extent to which auditors are considering this during the course of their audit. So overall, the FRC is looking to step up its approach in relation to climate change. This is a very important area for us. We think it's one of the defining issues of our time. And these are some of the areas that we're looking to step up our activities on. Thank you.
So I get to go last. I'm Fiona Frobisher. I'm from the Pensions Regulator, where I'm head of policy there. And I think I'm going to start by saying we're not doing any reports. So we don't know, we're not doing any of those. What I am doing is working very closely with my colleagues here over these kind of across all these issues, which we are being developed together. And where we are, it's kind of right that I'm going last because we're sort of at the end of this. So we regulate pensions. We regulate occupational pensions, the ones that employers offer their employees, not the personal pensions. And there are a lot of them, and there is a lot of money in them. So in our kind of like DB pensions, we have something like 6,000, and they have 1.6 trillion pounds worth of assets in them. That is a lot of money. DC, the defined contribution schemes, are not as big at the moment. They have about 60 billion pounds worth of assets in there, but there's 11, 12 million people saving into them, and a lot of them have just started saving. They've been swept in by auto-enrolment, mandatory enrolment into schemes, so those pots are going to grow and become more significant over time. So we're talking about large amounts of money that are invested, and for many individuals, that's the biggest exposure they have to the stock market anywhere. They don't have other kind of savings. They have pensions are the one kind of set of savings they have. So it has the potential to be transformative. The trustees, they are, I have to say, you were starting off by companies being quite short-termist. Trustees should be good about thinking about the long term. Looking after pensions is thinking about long-term risks. It's how you look after money now to make sure that people have it in future. So they really ought to be able to take these kind of risks on board. Anyone want to guess whether they're doing very well at the moment? They're not doing very well at the moment. So we baselined where we think people are, and I think about 22% of schemes say that they think about climate risk at the moment, that it's part of their investment strategy that they've thought about. They're going to have to change pretty quickly because just this month we've come in with, there are some new mandatory rules that schemes have to consider the financial kind of material aspects of ESG type risks, which includes climate risk. So they need to now start considering them. This sort of racks up over time. The requirement to consider comes in now. Next year, 2020, they'll have to explain how they've started to think about those. And then we're moving towards 2022, where particularly the larger schemes anyway will have to report their strategies and how they've done it in terms of the TCFD. They'll have to explain in that way what they are doing. So there's some kind of ratcheting up there to be done. But I suppose there's kind of three aspects to the requirements that have come in. So the first one is to consider climate risk and ESG factors as financially material factors to schemes. So particularly, I think this is thinking about kind of like the downside risks. I think one way of trying to get trustees to think about this is to get them to think about the downside rather than getting into arguments about, does this improve our returns? Can we think about it? It's like there are massive downside risks here that you really need to be thinking of going forward. So getting them to think about those. There's a second requirement for trustees of schemes to think about and be clear about how they reflect any non-financial kind of interests of their membership. And so we're not saying that if your membership are really concerned about a particular issue, a particular social issue or a particular environmental issue, that you have to invest in that to the expense of financial return. But when you are considering financial returns, you can also consider the non-financial factors and how they may be of importance to your membership. There's quite a lot of evidence, I think, as you know, that for younger people, millennials, a lot of the people that are now being swept into kind of pensions through auto-enrolment are more likely to be interested in those savings or more engaged in those savings if they are saving in line with their beliefs. So it's a way of engaging the membership, which can in itself be useful. And the third thing is the trustees of scheme are stewards. So the stewardship code, which Phil was talking about, the trustees are stewards of these assets, and they can use their kind of voting rights to reflect their investment beliefs for the scheme and make sure that they are voting in such a way that this happens. So they have the opportunity to achieve change in this area. if with the information that is put in front of them, with the kind of the requirements that are put on them to think about it, they can actually, by investing in different products, by voting in different ways when they are steward of assets, they can help or encourage various kind of companies to change in different ways, so they can have a real effect on that. As I said, we're starting, we know, from quite a low base. We have put out guidance for how we expect trustees to think about these kind of things. We've updated our general investment guidance to cover these kind of things. We'll go into our educational material, we'll do that too. But we're starting working with some of the largest schemes this year, where we have one-to-one supervisory relationships. We're going to go out in the next couple of months as the requirements have come in and ask them what they're doing and see how it's going. So we will look to kind of move them where they haven't done that. And we will also look to try and, if we can capture some kind of good practice that's out there already and best practice, that we can play that back out to the other trustees who may be a little bit slower to do this, a little bit more foot draggy, and see if we can get them to start thinking about these things more concretely. Thank you.
Great. Well, thank you very much for that. I was just listening to that strikes me just how much activity is currently going on. And I think if you had been having this conversation 2 years ago, the speed at which this activity has ramped up has been quite extraordinary. It's clear also there's lots still to come. And I think the other key message that I'm sort of been taking from these, listening to these conversations is that there's a lot of support behind this for these actions being taken, and I think that's something that's definitely worth noting. Now, just before we open up onto the floor, I'm conscious that we've been talking at you for a little while, so pardon me if I continue to talk at you for a little while before opening to questions. But the other piece of the jigsaw that I just wanted to add into this regulatory environment that seems to be emerging is that of the EU Sustainable Finance Action Plan and the position they've taken. So within Treasury, we've been leading the negotiations with Council on a number of files that have been developing there. So the EU has taken a relatively similar approach, I would say, to the UK when it comes to approaching green finance and sustainable finance. Just like the UK first set up the Green Finance Task Force, chaired by Sir Roger Gifford, an industry-led task force to come up with recommendations, the EU set up a similar body, the Higher Level Expert Group, which was industry-led, to come up with recommendations for them. This led to a Sustainable Finance Action Plan from the EU, which has started a number of actions, not necessarily just regulation, but there are a few, for example, which looked at TCF disclosures, a green bond standard, and I think what they're planning to look at in the future is an EU eco-label. But in the meantime, there have been 3 new pieces of regulation that they've come out with, which I want to briefly touch on now. So you've got the financial disclosures requirements, there's a new regulation on financial benchmarks, and then there's also the Sustainable Finance Framework, or more commonly known as the EU's taxonomy. So very briefly then, the disclosures file looks to introduce mandatory disclosure obligations for asset managers and institutional investors to disclose how they are considering or incorporating ESG factors, including climate risk processes into their financial decision making. There's also the financial benchmarks file. So this is looking at benchmarks when it comes to comparing companies and products. This is looking to intend to enhance ESG transparency of benchmarks and introduce minimum standards for calculating the methodology for 2 new categories of sustainability benchmarks. And again, the objective of this file is looking to address some aspects of greenwashing. So those 2 files are actually relatively advanced now. The third file, which has been received quite a lot of attention, I think it's fair to say, is that of the taxonomy, and is still progressing through the Council, and with the European Parliament. And the reason it's been receiving not a lot of attention is not necessarily because there's a particularly huge regulatory requirement that's attached to the taxonomy file, although I imagine if there's anyone in the asset management industry here, they might disagree with me. But on the face of it, the taxonomy file doesn't look to achieve that much. But what the taxonomy file will do is that once it's up and running and once it's in existence, it will provide a tool for governments and the private sector to leverage off, to point to reference going forward. And I think added that to the nitty-gritty of when it comes down to the political decisions of what is defined as green, which is what the taxonomy file aims to do, to go through a bunch of economic activities and looks to list out those which the EU will consider to be sustainable. Once you add that together, it starts to become quite a complex file. Now, taxonomies already exist. In the UK, the two main ones that we've got is from the Climate Bonds Initiative, and we also got the FTSE Russell. But what the EU taxonomy does, which goes beyond those, is it really gets down into a level of granularity which the existing taxonomies just don't do at this level. So now, to give an example, for example, one of the requirements that they're suggesting that to be classified as green, you would, in the energy sector, you would have to meet a target of 100 grams of CO2 per kilowatt hour in order to be classified as green. And if you amplify that across other economic activities like particular train emissions of certain types of trains, vehicle emissions, forestry management, the list can balloon quite quickly, and so can the complexity. So it hasn't progressed quite as quickly as the other files have, but that's not to say that the file hasn't been making progress. And what happened in the summer was that the group of advisors that the EU had commissioned to look at the fine detail of what benchmarks, as it were, should to be defined as green, they came out with quite a lengthy report, a real page turner if anyone's interested, in the summer, which looks to list out around 50 economic activities ranging from all different types of industry and how they consider those might be green. Now, I appreciate that most people in this audience are probably from the public sector, and they're thinking, okay, how is this going to be related to the area of the work that I do? But if I could just leave you with this thought that if anyone's here from, I don't know, from a local authority or from a particular arm of a government, either in the UK or abroad, and are thinking, we've got a particular project that we'd like to develop, we might not have the public finance for that project, but we're looking to, one option would be to go out and source some private sector finance. I think it's definitely worth considering the EU taxonomy and the direction that is taking when you're developing those proposals. And I'm conscious that the taxonomy is still developing at this time, but going forward, this is the sort of this is the requirements that the private sector could be looking at when they come to invest in green. And on that note, I'd like to stop speaking and hand over to the floor for any questions. And it's so great. So if we take in the middle first, maybe perhaps if we take two and the gentleman behind on the row as well.
It's for Fiona, I think, and it's a personal experience, and I don't know how widely replicated this is, but a couple of years ago, certainly pre-TCFD, with our occupational pension scheme, we were looking to incorporate consideration of climate risks. And what we found was that the trustees were completely supportive, and that the asset managers were completely supportive. Whatever we asked them to do, or whatever they were asked to do, they would do. It was the advisors that were the absolute challenge in the process. And I don't know whether that's replicated elsewhere, but I mean, I did find it quite surprising and difficult.
So if we take one more, perhaps.
My question is on reporting. You focus a lot on TCFD and the I would say the periodic reports, maybe it's an annual basis. Would you, as regulators, look to adapt other regulatory reporting channels? I'm thinking at transactional level. So, for example, where we've got MiFID II that's come in, where you would allow reporting on green instruments, and therefore with the policy aim of improving liquidity in those instruments. So the question is really, are you looking to adapt existing regulatory compliance structures as opposed to bringing new ones just for green finance?
Fiona, do you want to?
Yes, I'm going to semi-answer because I'm not going to the deep reporting. It's certainly kind of like, as far as we regulate, we attempt to put all the kind of new reporting in current structures rather than bringing something new in. So the requirement to account for how you're accounting for climate risk in pension schemes, for instance, goes into your statement of investment principles. So that already exists. Trustees are supposed to review it on a kind of regular basis, and it just goes into there, so it goes into something that's regular. I suspect everyone's going to say the same, but we'll see. Your point about the advisors, that's sort of interesting, sort of depressing. I am kind of aware, particularly a few years ago, that, and I think we're over this now, but this problem between financial return and seeing everything that was an ESG factor or a climate risk factor as a non-financial factor. And I think lots of advisors kind of split it into two things. That's not hard financial factors. And I think one of the things that's really changed over the last couple of years is a very clear understanding that climate risks and ESG considerations are materially financial factors. They have a material financial effect. And we've been very clear about that. The Minister for Pensions has been very clear about that. And I think that message is sort of cut through. But you've also identified an issue about the fact that making any of this work, kind of needs us all to get all the parties to sign up, which I think is the point that everybody who's been making along here. As regulators, we have to kind of have a united front on this. So where we all have different levers on different parts of the industry, on advisors, on providers, on kind of people who do the measuring and the instruments and those kind of things. We need them all to be having the same understanding of what the climate risk and the factors are, and kind of the same reporting.
I think, if I may, I might just add to that and say that the stewardship code or the revised stewardship code will apply not only to asset managers but also asset owners, proxy advisors, etc. And you know, when we increasingly we hear investment managers talking about a greater integration of ESG, and that's partly, you know, because of societal demands, but it's also partly, exactly to Fiona's point, is you have, you know, in order to identify sustainable long-term returns, you have to take into account, in my opinion, ESG factors in that investment decision-making process. So it would be very interesting if you started, you know, ask the question again this year as to whether you got the same answer from the advisors. I hope not. Well, come back to us and tell us how you get on.
Yeah.
And yeah, I mean, in terms of, I think the answer in terms of things like the MiFID reporting question and whether we could use other regulatory reporting mechanisms is possibly, but I think what we really need to do is get the foundations in place first before we start having considerations around how other tools could be used. And also, I think certainly when it comes to MiFID, I had the great pleasure when I was at the Treasury a couple of years ago of having to implement MiFID. And I think it's fair to say that we are still in the review period for that particular reporting process, and it's important that we understand the effectiveness of what's been put in place and what revisions might be required, including any revisions that might be required around this area before we move forward with that. But it's a good question.
Any other questions? And please do introduce yourself as you do. I see why don't we start off at the back and then we'll come down here.
Georg Oftedal from the British Embassy in Oslo. A question to the panelists. What would be the best set of regulations in an extractive resource-based economy, such as oil and gas, to support the transition to the green economy from a brown economy?
Here.
Hi, I'm Fiona Jackson. I'm working at Bayes at the moment on non-financial reporting. A lot of the themes that I found through today is a lot about disclosure, standardisation, clarity. It's something that we're finding as well at the moment. We're doing a lot of workshops with auditors, investors, and with yourselves. And I think the question is, so the report you mentioned coming out about new guidance, is that something that you intend to keep national? Is it something that you're looking to take international as guidance? And I know it's a bit of a tricky question, but do we know when it's going to be published? With government, it's never quite simple.
Perfect. So we've got two questions there on what are the best regulations to support a currently brown industry and country moving to green, and then this concept of disclosures we're talking about at the national level. How can we take this international? And then the question as to when the report's published. Any?
Oh, I thought you might forget the last one. Good. Shall I have a go on a couple of points? The Financial Reporting Council is all about disclosure and transparency of how boards are operating and what companies are doing to address the material challenges in place. I mean, for us, we encourage oil and gas companies who are clearly contributing significantly more to climate change than others. We encourage them to be transparent, to set out clearly how their business model needs to or will change as a result to address climate change. And then the market then makes up its mind as to whether the actions that they are taking in the future are appropriate and make investment decisions on the back of those. So for us, it's very much encouraging those companies to set out what their business model is now and what it will be in the future to address climate change issues, to give the market the best information that they can have to take informed investment decisions. And one will lead to another if investors start to make decisions on oil and gas companies who are perhaps they're seeing as not being sustainable, then that's going to change behaviour as well as change reporting. I don't know whether that answers your question, but that's certainly our approach. Transparency is important to enable informed investment decisions to be taken.
If I can just chip in here as well and try and answer some of these questions. So I think to the first question as to what types of regulation are needed for when you're looking at to assist a brown moving to a green economy, I think you need to look the regulation spheres that are generally shaping up seem to be sort of focused on green and trying to promote and stimulate the green side of the economy. But at the same time, you've got this other side looking at the risks. What are the risks of stranded assets for, when you're looking at a brown industry? And I think you really have to look at both in parallel, which is what we've tried to do to a certain extent in the green finance strategy. You've got to help develop a green market to enable the technologies and the industries to replace brown industries in the longer term, and at the same time you've got to look at the prudential risk, which is the whole premise of TCFD for the risk of stranded assets in the brown industry as well. And just to come in on as well on the international versus national, there are a number of I think it's fair to say there's a number of schemes. You've got the Network for Greening Financial Services. You've got the, obviously you've got the EU, which has recently set up their international platform. You've also got the Finance for Coalition of Ministries. The Coalition of Finance Ministries, which is to a certain extent looking at these types of issues. And I think there's a number of different forums which are trying to take these issues forward.